This webinar is about Midtown Ridge, which is a multifamily property in Chattanooga, Tennessee. So this is a 193 unit value add property with proven upside in a terrific high growth market. And we're very excited to bring you this property because it's also the final property in our Sun Belt focused Grow Capitalist Value Add Fund. And it is the beginning of what we call the sweet spot window. This is a short window of time when prices are highly depressed because of extremely high interest rates and amazing discounts are available, even though everyone in the market now knows that interest rates are going to decline this year and decline next year. Now, most of you know us well. For those of you that are new, we'll spend a moment at the beginning to tell you a little bit about who Grow Capitalist is, and then we'll spend our time talking about this amazing market. We'll review the opportunity, the property, its design, its features, and then we'll finish with the time frame, numbers, and we'll take your questions. About 35 minutes. Before we go further, this webinar is not a solicitation to purchase any kind of securities. That kind of offer can only be made by a PPM or private placement memorandum. The webinar is just an informational summary, so a marketing summary of this opportunity. And all of you need to look at the PPM and all of its exhibits before you can make a complete decision about investment. Here is your first look at Midtown Ridge. So good size property, 193 units. It was built in 1986, so reasonably new property with strong bones. The property is spread across 9 acres. It has a very strong 93% occupancy, equally strong average effective rents at $1,248 per month. So, okay, let's spend 90 seconds introducing Grow Capitalist for those of you that are new to our ecosystem. If you're new to our webinars, we manage a portfolio of nearly $1 billion spread across 32 projects in 10 states in 17 metros. And almost 1,000 of you have given us slightly over $300 million of equity to buy assets like Midtown Ridge and also like the ones that we're going to show you on the next page. We've had 8 exits, and our most recent exit, which was last month, by the way, doubled investor money in 4 years, even though we were selling the asset in a highly challenging market. And speaking about those exits, we have a very strong track record. As you can see from this slide, on the left, the gray box showed our initial projected internal rate of return for those 7 exits. This is our average annualized return for those 7 exits. But the actual returns shown here in blue were basically double those numbers. Now, this is easy to do for 1 or 2 or 3 properties, but we've now done it 8 times. And for those of you that are new to us, this should be the most important factor when you're deciding to invest with us. And our investors, they love what we're doing. For instance, Jennifer Fu, she's a very experienced investor. She has investments with many syndicators, and she mentions in this review that her ROI with us beats all of her projects with all of the different companies that she invests with. Once again, if you're new to us, this really is what you should be looking at. Now, Dr. Pada is one of our savviest investors. I'm going to stop my video for a second here and see if that fixes that flashing, which is weird.
It's your green screen.
Yeah, yep. So hang on. Let me switch this green screen over. So Dr. Pada is one of our savviest investors because he's a general partner in lots of projects of his own. And he loves the way we work and even agreed recently to guide us by being on the board of one of our companies. And now we want to talk about why this is an incredible time to invest in multifamily. Both of us, Anna and me, we truly, truly believe that 2024 is going to go down as one of the best entry points into the apartment market for a very long time. Let's talk about why we believe that. Firstly, we know, along with everyone else, that the Federal Reserve is now done with their rate hikes. Now the focus is on the exact date when the rates are going to start going down. And our bet is that the first rate cut will come in March or in April. What's exciting to us is that even though everyone knows this, the market's still factoring in today's extremely high interest rates when setting prices. The sellers, they've adjusted to a new lower priced world, and buyers, they still have to deal with the high interest rates in the coming months. So they're asking for huge discounts. And we all know that these discounts can't last. So savvy investors are very focused on taking advantage of this short window. And another reason to buy today is the amazing strength of the US economy. The economy has been far more resilient than any analyst's prediction from a year ago, including ours, by the way. Wage growth has now finally surpassed inflation, growing faster than inflation. So buying power is increasing again. And that means rents can be raised. Yet another reason to buy today is that even though interest rates are high, there are still some properties, some available with assumable fixed rate loans. So you get the discounts, but you don't have to deal with the reason for those discounts, the high interest rates. So best of both worlds. And the final reason is all about this chart. The resilience of single family home prices means that the monthly mortgage here in orange now exceeds the monthly median rent by more than 50%, more than 50%, right? It's almost double. The biggest gap in history. For most markets in the US, it absolutely makes no sense to buy. It makes perfect sense to rent. Here, by the way, are the rate cut expectations for 2024 from different analysts. I think the slide speaks for itself. The range is fairly wide. On the left, Wells Fargo and TD America think the Fed could go nuts. They could cut as much as 225 basis points or 2.25%. On the other end, there's a few that believe that we might only get 50 to 75 basis points of cuts this year. The average rate cut prediction is 130 basis points or 1.3%. And believe us, we would be very happy with that average because a 1.3% change in rates would give a tremendous boost to apartment prices 1 year from now, which is why we want to buy as much as possible in the coming months. Now, you can see on the right that the economy is supporting continued price growth and rent growth. Now, we added over 200,000 jobs in December, and you can see that inflation is declining. Look at this sharp decline here in orange, but the unemployment rate is still, after 18 months of rent hikes or rate hikes, is still at a record low of 3.7% today. And what this chart is showing that after 2.5 years, where inflation was running faster than wage growth, so you have less money in your pocket, that situation has now reversed. And wages are again growing faster than inflation, which is allowing us to raise rents. The bottom line is this. Inflation's falling, rates have peaked, and we have very strong discounts in the market today. And this is why we believe that the first half of 2024 is an outstanding and short window to buy multifamily at amazing prices. And that's why we're so excited about Midtown Ridge. So here's another quick look at Midtown Ridge in Chattanooga, Tennessee. The 4 key things that you should know about Midtown Ridge. First, we're buying at a very high cap rate of 6.8%. Remember, the higher the cap rate, the lower the price. So the profit is really in the buy, not in the sell. On top of that lucrative price, we also benefit from a fixed rate loan. Not only is the leverage very strong at 79% LTV, you can't even get to 70 today, by the way. And we've also got almost 5 years of interest-only payments with a fixed 5.3% rate in a market where today, if we're buying, rates are over 6%. So interest-only means more room for cash flow, and a fixed rate means no money wasted on an expensive rate cap and zero exposure to this high interest rate environment. One last point that's critical. Chattanooga is a growing market. All of the indicators are in the green. But what's really good is that this market's rent growth, it didn't overheat, unlike Texas markets, Nashville, Phoenix. So unlike those markets, Chattanooga's rent growth is projected to be reasonably strong going forward into 2024. And the market doesn't have a lot of new construction. So this market doesn't have the supply risk from incoming projects that you've been hearing so much about in our webinars. All right. Just 5 months ago, after all the rate hikes were done, Fannie Mae, the property's lender, appraised this very property for $7 million more than we're paying. $7 million more. And remember, this was after all the rate hikes. The lenders are in a very conservative mood when they're assessing properties. Usually when you buy a property, even if the appraisal comes in 1 million or 2 million over, that's reason for a celebration. But with this property, it's a $7 million number. And that's unheard of, in our opinion. And most people, they don't even know where Chattanooga is. Well, it's located near the Georgia border, so great trade connections to Atlanta and all the other Southeast markets. It's also deeply tied to the 2 main Tennessee markets, so that's Nashville and Knoxville. It's got a wide variety of industries, very strong physical location and connections, And so this market's seen very consistent rent growth, very consistent occupancy growth. And by the way, it's also known as Gig City because it has the world's fastest internet. Now, Chattanooga's strongest connections are with Atlanta, which of course is the very epicenter of the Southeast's economy. Atlanta is a red hot real estate market, huge economy, massive population growth, about 6 million people. 29 Fortune 500 or Fortune 1000 companies are headquartered there. And Atlanta's growth is really helping regional markets like Chattanooga. And our analytics are showing again and again that there's a lot of potential to be, a lot of profit to be made by investing in the secondary markets that are not overheated but are close. Atlanta consistently wins accolades of all kinds, and the latest one has been from the NAR, National Association of Realtors in 2020. They think it's the #1 housing market to lead the nation. Once again, knock-on effects for Chattanooga. Now, back to Chattanooga. As you can see from this graph on the right, the city's physical location is a terrific advantage. And this is why nearly $5 billion have been invested in Chattanooga since 2017. From car companies to tire and battery companies, logistics giants, employers are continuing to invest in Chattanooga's economy. Now, it's no surprise that Chattanooga is the fastest growing city in Tennessee, faster than Nashville, faster than Knoxville. Younger people are attracted by Chattanooga's very, very lively, very attractive downtown. And the city is currently ranked #9 top housing market in the US by Realtor.com. And you can see from this employer list here on the right, it's got a terrific mix of employers. So education, healthcare, auto, utilities, government, manufacturing, you name it, it's got it. Volkswagen, for example, has completed an investment of over $1 billion into a new assembly plant that can create up to 16,000 jobs. They've also announced plans to invest another $800 million related to electric vehicles and are also building a regional headquarters in Chattanooga. And here on the right, you can see just how well Chattanooga's urban renaissance has gone. This picture is of the Riverfront District, which has a lot of trendy shops and eateries with an impressive economic output of $115 billion. Chattanooga has received kudos globally for its rapid urban development. It's considered a shining example of successful downtown revitalization. Amazon is expanding strategically into Chattanooga with a 1 million square foot distribution center with up to 2,500 workers. One of the key areas that Chattanooga is leading in is in healthcare, with 4 different multi-hospital systems expanding in Chattanooga with big names such as Blue Cross Blue Shield that are fueling a 13% increase in employment in Hamilton County. Now, we mentioned this before, but we want to emphasize it again. Chattanooga has a really impressive infrastructure. 3 major freeways, you've got a designated free trade zone, extensive rail connections, 16,000 miles of waterways, and an inland port that make Chattanooga a thriving logistical hub. And the local energy and telecom provider, they called EPB, they've built a commercial quantum network with 200x faster download speeds than the national average. So I know where I'm going to be downloading my BitTorrent movies. University of Tennessee, Chattanooga has over 11,000 students, so it's growing rapidly. And so it's not surprising that there is a boom in Hamilton County's young demographic. As you can see from this graphic on the left, the nation's growth for 25 to 34-year-old is about 10%. The state of Tennessee is close to 15%. And Hamilton County, which hosts Chattanooga, is at 20%. So as these young people, they get married, they have kids, they're going to reach their peak spending in the next 5 to 10 years, driving up the cost of housing even further. And because of its natural beauty, its buzzing art scene, Chattanooga gets a stunning 15 million visitors a year, with over 25,000 tourism and hospitality jobs. Now, on the far right here, you can see the completed downtown revitalization plan, and it attracts a lot of those 15 million visitors. It's also a top-class outdoor destination. It's ranked best in the US by Lonely Planet. This is Lookout Mountain, Southern Belle River cruises. They attract millions of tourists. Now, after its success with that downtown revitalization, Chattanooga is now driving forward with a 300-acre transformative riverfront development. Our property, Midtown Ridge, represents a strategic acquisition in this city that is experiencing this robust economic growth and is also working on very major development initiatives like this one, The Bend, and this one, One West Side. Okay, I'm done bragging about how awesome Chattanooga is. Let's talk about why Midtown Ridge, which is shown in this picture, is a great use of your investment dollars. The biggest single advantage of the property is its micro neighborhood location. So this neighborhood, which is called Brainerd, is only 4 miles from downtown, just 4 miles, and has over 60% white collar residents. The income growth in this neighborhood, almost 20% in 2 years, one of the highest in the entire country. 93% of the region's jobs are accessible within a 30-mile drive. So that's driving up home prices in this area. So much so that Brainerd is forecasted to appreciate by over 36% in the next 3 years. Yeah, that's 12% a year. Again, one of the highest rates forecasted for the country. Its population growth is over 5% over the last 2 years, which is more than 3 times faster than the US average. Now, apartments have generally seen vacancy rates go up in the last 2 years, but Brainerd's apartments have seen a very significant vacancy reduction. So this is a very strong micro neighborhood. To dive in further, Midtown Ridge, the property, is located right off 2 major freeways. And it's very much near a centralized corridor, which has a new Topgolf, it has a Bass Pro Shop, it's got a Walmart, 2 major hospitals. The airport and the big local mall are only about 10 minutes away. All right, now that we've studied the city and the neighborhood, I'm going to turn it over to Anna. She's going to dive deeper into the property itself. Anna?
Thank you, Neal. Let's start with some visuals. So here are some pictures of the property. I personally like the really large balconies that both ground floor and the second floor units have. Chattanooga is blessed with good weather. So the balconies, those are a great selling feature. Now, at the top left here, you can see that the leasing office has gotten a lot of love by the previous owner. But at the top in the middle, you can see that the landscape areas are in desperate need to be pressure washed and have new planting put in. Also, the area near the pool, that's also going to be professionally pressure washed and make it pop. And the pool will get brand new pool furniture. Now, let's check out a little video from the property.
We are at the center of Midtown Ridge. You can see one of the 2-story buildings directly behind us here. You can note that all of the different buildings, each unit either has its own private patio or balcony. Walk in the front door. Here's the living room. Bonus room in here. Here's the kitchen.
Love that bonus room.
Yep.
Bedroom number 2.
Large bedrooms.
Mm-hmm.
What I want to show you right now is really what is directly across the street from this property, and this is Audrey's Place, a brand new single-family build-to-rent development that was just completed earlier this year. These are mostly 3 bedrooms. They lease for a premium well above anything in our property, and this is a good sign having new development just adjacent to this property, as it's something that can help uplift this submarket long term.
Awesome. So let's take another look from Audrey Place's website. This is a photo on their website at our terrific location. We are right in between that brand new build to rent community and lots of services on the other side, shopping, movie theaters, all with easy 3-way access. Now here's a quick top view of the property. Now interior amenities include ceiling fans to deal with that fierce southern summer, fireplaces for the winter in most units, a patio or balcony in many or most units, and that bonus room that we saw in, again, most units. It's a great space for office or playroom. Almost all the units have washer dryer connections. Some of them have actual laundry rooms. And then there are walk-in closets or very sizable closets and storage in pretty much every unit. Let's take a look at the floor plans, starting with the 1-unit, 1-bedroom. They're very tenant friendly and market competitive. You can see they're quite roomy at over 750 square feet. And you can see that bonus room called a solarium. This really matters a lot for incoming tenants to have that just like extra space. The 2 bedrooms are quite large, larger than all of our other properties, honestly. And the same for the 3-bedroom units. At 1,375 square feet, they are just huge. And they've got lots of storage. And again, a full laundry room. Very unusual in a apartment unit. So moving on to unit condition. Here you see pictures of a classic or an unrenovated unit. You can see the tired white cabinetry, the white appliances, the creaky older flooring. There's a lot of renovation potential here to pop those rents. And next you're going to see, these are some partially renovated units. You can see, yes, the cabinet finishes have been refreshed. There is new cabinet hardware. There's modern lighting fixtures. There's accent colors, resurfaced countertops, and new vinyl flooring. This has been really well received, and these partially renovated units, those have received rent bumps for the current owner of $220 a month for these partial renovations. Very big numbers. That's a terrific number. And it's honestly much higher than what we are projecting in our underwriting. Now, the previous owner did a commendable job with a $3 million investment into interior and exterior capital expenditure projects, from lighting, plumbing, HVAC, the pool and spa enhancements. A lot of money was put into common areas and those units that we looked at, and it showed. But if it wasn't, really, Neal, if it wasn't for the rate hikes and the current condition, we really would not be able to even afford this property, because the cap rate would not be this high on this sale.
Yep.
But I have to say, Neal, while the previous ownership did a commendable job with upgrades, they did a disastrous job with the property management. And you can see that top left, the property has terrible reviews on Google. And after reading the reviews, it's really clear that the property management team was just awful. So immediately after purchase, we will rebrand Midtown Ridge to Equinox at Midtown. And branding is not just about a name. It's about a new community identity. It's driven by higher tenant satisfaction and retention. We're not new to rebranding. In fact, on the right, you can see an example of rebranding that was done right. That property being shown in these pictures was just sold last month for a 2x return in 4 years after a successful rebranding. Now, our value add strategy here focuses on transforming 79 of the classic units, taking them from classic status to a partial renovation with better aesthetics than we just saw. And we're thinking that's going to get us to a rent premium of a blended $177 a month per unit. Now, that plan includes cabinet repainting, laminate cabinet resurfacing, the addition of kitchen backsplashes, modernized bathroom vanities, mirrors, two-tone paint for some depth, some character, and then we're going to standardize the appliances throughout. We're going to replace those mismatched sets with sleek black appliances. Here you can see our budget on the left, and we are planning on spending about $7,500 per unit, which is a healthy amount, to bring the 79 classic units to this partially renovated level for that $177 projected rent increase. And that is a 24% return on investment. Now, this is key. In the future, when we are preparing to sell, we're going to upgrade a small number of the units, maybe 6 or 8, to a higher spec. That's when we're going to do the granite countertops, the stainless steel appliances. And then once we get those rent bumps on those small number of units, this will become the demonstrable meat on the bone for the next buyer, that where they can take that property. And this is going to allow us to exit at a strong price and achieve our 2x profit goal. Now, while the previous management did a lot the job of exterior renovation was incomplete. So on the right, you can see our exterior upgrades and the repairs budget. It's over $1 million, and nearly $500,000 goes into long overdue repairs and deferred maintenance, which are sorely needed for tenants to really feel welcome and for those Google reviews to move upwards. And that's going to drive more traffic to the property. Now, we've done an extensive, backtracking. As you can see from this chart, Chattanooga's rents, that's the blue bars, those dark blue bars, at $1,377 a month average. They are much lower than the national average, which is the gray bars. And that means that there's much more headroom for these rents to keep going up. And this is exactly why Chattanooga's average occupancy has been higher than the national average in the past. And that's the area to the left of the current time. And that's also why Chattanooga is projected to have higher occupancy than the US going forward all the way until 2028. And as you can see from this blue box up in the upper right, Chattanooga is not getting hammered from oversupply like Texas and Arizona markets. You can see that in 2024, Chattanooga will receive 1,400 new units, while it will absorb 1,800 units. With demand greater than supply, Berkadia and other data providers are projecting smooth rent growth in Chattanooga, which is very important. Now, we've done an extensive analysis of our rent comps, our comparables, and we feel that the property is quite well positioned for future rent growth, and it's quite competitive to the other properties in the market. We've also looked at sale comps, and we feel that compared to last year, we are getting a significant discount, and that discount really makes a strong case for the purchase of this property. The property will be managed by Asset Living. Now, we've worked with them at properties nationwide. In fact, they're also managing one of our other properties 20 minutes away in Dalton, Georgia. Asset Living they've received many accolades, including being ranked #1 for NHMC's top 50 property managers for multifamily. That's a very big deal. They have 37 years of experience, and they're managing over 200,000 apartment units. We are right now closely reviewing and double checking our numbers with their team. So to summarize, we believe that Midtown Ridge is a terrific risk-adjusted investment opportunity. We are buying at what we consider to be a large discount. We have a terrific loan with high leverage and 5 years of interest only with a fixed interest rate. And that means higher cash flow than comparable projects. We're buying in a market that is not oversaturated from new construction. The location and micro neighborhood are simply terrific, really good. And that's really appropriate for a 5-year hold. Now I'm going to turn it back over to Neal to walk us through the financials and take us home.
Thanks, Anna. Let's finish this presentation with an overview of the investment. We're going to go over projected returns and cash flows and fees, depreciation, and we'll show you 3 different ways to invest in the project. Now, the sponsors, that's us, Grow Capitus, are investing $400,000 of our hard-earned money, which is a bit more than 4% of the raise, so our money is at risk alongside yours. The total all-in project cost is $31.4 million, which includes $1.84 million for interior and exterior renovations. We're buying the property at a purchase price of $29.6 million. Remember, it was appraised for $7 million more 5 months ago. The $23.4 million loan, fantastic, because it's at a 79% LTV and it's being assumed from the seller, right? It's got a fixed 5.3% interest rate with almost 5 years of interest only, IO, so that gives us more cash flow. And that the total equity raise is $9.8 million, but of that, $1.5 million is already in the bank even before the raise has started. And because of the high loan to value, almost 80%, there's less than $10 million of equity for a $30 million asset purchase. So this doesn't just boost the cash flow and the returns, but it also boosts something else, year 1 depreciation for you, for the investors. Our cost segregation company is called Engineered Services, and they've projected $55K in year 1 depreciation on 100K investments. In 2024, 55% is almost impossible to achieve because bonus depreciation has dropped from 80% to 60% this year. Most other properties would be well below 50K on a 100K investment, but this one has high leverage. Now we're charging very standard fees, so 2% one-time acquisition fee. There's a 1% annual asset management fee. There's a 1% loan guarantor fee, so 1% of the loan, and a 1% disposition fee that we'll charge when we're exiting 5+ years from now, 5 or more years from now. Now, the preferred returns or pref, they vary from 6 to 9% a year. That depends on how much you are investing into the property. Now, if you're new to syndication investing, a cumulative pref allows investors to get exclusive access to a certain amount of profit before the splits kick in. So the splits between the general partners, that's us, and the limited partners, that's you, are 70-30 after pref, and this 70-30 is for the vast majority of investors. So 100% of the returns go to you until your annual pref is first paid out. And then after that, 70% of the remaining profits go to you, 30% go to us. Now, investors that are investing $1 million or more, probably through a fund of funds, they get a higher split. They get an 80-20 split. So we keep 20%, they keep 80%, along with a higher pref. Here you can see the different classes. So there's 4 different classes. Class B1 can invest as little as 75K and get a 6% annual preferred return with a 70-30 split after that pref is paid. For Class B2, the minimum investment is 125K and it comes with a higher 7% annual pref. For Class B3, the minimum is 200K, so the pref gets bumped up again, this time to 8%. Now, for all 3 of these darker blue ones, B1, B2, B3 classes, the split between you and us is 70 for you, 30 for us. Now, sometimes, not very often, but sometimes we have a single investor who wants to deploy millions of dollars, or we might have a fund of funds that wants to invest in our projects. Not very common. But for those single check $1 million investments, we bump up the pref a little bit from 8 to 9, and we also give them an 80-20 split after the pref. So now that you understand the classes, let's take a look at the returns for those same classes. So as you can see, the total returns, they vary. Why? Because of the change in the preferential treatment or pref. So for Class B1, we project an equity multiple of 1.9x. What that means a 95% profit in 5 years, by the way. For Class B2, we project a 2x multiple or double your money in 5 years. And for Class B3, that projection moves up to 2.04. Now for the Class C, that $1 million class, because of the higher pref and the 80-20 split, that number moves up a little bit further to 2.19x. Another way of looking at these returns is to just look at simple annual returns, or AAR, average annualized return. And here we're looking at roughly 19% a year, 20% a year, 21% a year annual returns in our projections. Now, same slide as before, right? But this time we're showing you cash flow if you're investing directly into this property. Now, because the property has an interest-only loan and the leverage is excellent, we're projecting higher cash flow than the other properties that we purchased in the last year. As you can see, projected cash flow for Class B1 is around 6%. It stays at that level since their pref is 6 and is met with this projected cash flow. For Class B2, we projected the cash flow will start at 6.3% and move up to 7.9% over 5 years. And that's for Class B3 and B4. The first 4 years, they stay the same. But the last year, they're catching up because they have a higher pref. So we have to catch them up to that higher pref, and that's what bumps up their returns. Now, you can invest in Midtown Ridge in 3 different ways. So let's take a look at those 3 ways. Now, all of the numbers you just saw, everything that we just mentioned, the projected returns, projected cash flows, they were if you were investing directly into this one property, Midtown Ridge, minimum 75K investment. As mentioned before, you can also invest in Midtown Ridge by investing into the Sunbelt Focus Grow Capitalist Multifamily Value-Add Fund. This is a closed-ended 3-property fund, so it's not an evergreen fund. And the fund already owns these 2 properties, Monarch Villas in Georgia and Park Avenue Villas in Florida. So these are properties, by the way, that were purchased over the last 13 months. So you get the benefit of that. So after we buy Midtown Ridge, this fund is going to close. And that's fantastic for those of you that have not invested in the fund yet, because 100% of your money gets deployed as soon as Midtown Ridge closes. And that's very rare with funds, by the way. Usually you have to wait a year, sometimes 18 months for all of your money to be deployed. So same minimum investment of 75K if you want to invest into the fund, but here you have diversification benefits. And this, by the way, personally speaking, is my preferred way of investing. Now, lastly, you can invest directly into Midtown Ridge, into this property, by sending us 1031 funds. And we put those funds into a compliant TIC, tenant in common structure. So you have 1031 in and 1031 out benefits. 1031 investment must go into a specific property. So you cannot invest in the fund, just into the Midtown Ridge. 1031 timing must align by end of March 2024. And the lender will only accept 5 to 7 TIC or tenant in common participants. So we do require a higher 250K minimum investment. We are giving priority to 500K investments. Now, one last bit on this. We'll be holding a live Q&A next Monday, Jan 22nd at 3 p.m. Pacific for potential 1031 investors to get the details on how to 1031 into a syndication. Anna and our lawyer will lead that. And if you answer on the poll that we're going to put up in a minute, if you answer that you're interested to 1031, then we'll automatically register you for that event next Monday. All right, that's it. That's our presentation. And Anna's going to be putting up the poll that I was just referring to. So please give us your soft commits. And if this project is not for you, please also let us know so we don't follow up with you. If you're ready to invest, the link to subscribe is on the screen in right here. You see that link here. And it's live as of now. So Anna's also, by the way, putting this link in the chat. So if you like the project, I suggest you do it right away. It's all first come, first serve. If you want to talk with us, Peter Majeski is our investor relations manager. His email and his phone number are in here, and you can also book a call by going to growcapitalist.com/investor-call, and can you also plug that into the chat. Now, it is important to note that while answering the poll for your soft commit is important, we do give priority according to the timestamp of the e-sign docs in the investor portal. So this link on the right, when you sign those docs, that's what gives you priority in the investor portal. All right.
So Neal, I'm going to put those things into chat, but I just wanted to say one important item. So in the investor portal and in the investor kit, when you go to that kit page, there is a saved version of this PowerPoint deck, and it has expanded content such as a detailed sensitivity analysis. It has a long list of frequently asked questions. It has a link to the detailed video walkthrough of the underwriting that Pete and I did, the underwriting and the analysis model. So just something to look out for, that this deck is expanded into even more content for you. And now I'm going to go about and add those links.
Yep, and I'm going to be showing you some of those FAQs. I know that some of you might have to jump off, but for the rest of you, well, I'll continue throwing some slides up while we answer questions.
Okay, there's the kit page, and I'm also going to post the link to. Now, we would love for you to ask questions in the Q&A, not the chat. It's really hard to keep track of questions in the chat because the chat kind of flies by. So please, please, please post your questions in the Q&A. Okay, just adding this link here. We have a bunch of questions going. Lots of people talking about their locations and their temperatures first. Okay, let's see. You say your previous investments have actually overperformed with great results. Do you think this will continue in today's environment?
No, I think that the returns that we are so proudly showing you were impacted by a one-time extraordinary increase in prices and a one-time extraordinary decrease in cap rates that cannot be replicated. What I would hesitate to say is, well, yeah, you know, we're projecting that we'll give you 16 IRR and we can do 32. I don't think anyone can do that. I think that the honest answer is, I believe that we can hit our returns, and I think we can overperform if the market bounces back, not to the 2022 madness levels. I don't think that's ever going to happen. But if it goes back to the 2019 level, which was a more normalized year with normalized interest rates, I believe that we can outperform these numbers.
Let's see. Is there no difference in the return? This is the investor's return, whether you invest in directly in the asset versus invest via the fund?
There would be. Keep in mind that the fund has 3 properties, and each of those properties is going to perform slightly differently. So I'm going to find a slide that basically shows you what we are projecting in terms of the fund's returns. And here you can see the fund's targeted returns. Right now that the fund, all 3 assets have been targeted, we have a better sense of this. And I think that these numbers are pretty valid. We didn't think that we would get to a high cash flow asset like Midtown Ridge. So the funds always have a range. A single asset tends to be pretty sharp on the range. You pick a number and you say, okay, this is what I think I'm going to get to. With the fund, because you have multiple assets, you have a range. So if you're investing into the fund, the IRR, AAR, cash on cash, and equity multiples are shown here. I do think that by now I have a sense that the equity multiple is closer to that 1.9x than the 1.5x. We didn't know this when we were creating the fund, so we wanted to give ourselves a big range. So a lot of these numbers, I think, are likely to be on the higher side than on the lower side. But a fund does not have numbers as tight as an individual asset does. So no, your returns would be slightly different from investing into this asset versus investing into the funds. And there's obviously a value for diversification.
Is 6.8% cap rate tax adjusted and insurance adjusted?
I don't know the answer to that,
is.
so I believe it is.
The answer is yes, it is.
Because I think we were in the 7s when we hadn't adjusted it.
No, it is. That's the cap rate and tax insurance adjusted. So I'll answer that one for you, Neal. Yeah, the answer is yes.
Yep.
When do you plan to close and when do you need investor funds by? I will take that one. So if you're not doing a 1031, we are planning to close by April, but that doesn't mean we don't need your money till April. Anyone that's coming into the fund, sign your docs, and once it's accepted and you pass the accreditation, that's when your money is due. It is a first come, first serve situation. When you sign docs, we don't hold your spot. So sign docs and come on in is what I would say.
Yep. And keep in mind that we're not just opening this up to our investor community. It's likely that we'll open it up to other investor communities out there. And those communities usually give us $1 million checks, right? So we'd like to give priority to our teams, but we also have other relationships outside of our investor base. So I think that another way of saying this is we're likely to close in April. We might close in March. So maybe it's March, maybe it's April. So the money that comes in, there's no return for your money until the time that the property is purchased. Now, if you're investing into the fund, obviously your clock starts ticking sooner because the fund already owns 2 properties.
So why is the seller selling at a big discount? Is a rate cap expiring? Do we know?
Well, we don't believe the rate cap is expiring because this property has a fixed loan. So that could not be the reason. A rate cap is only used if you have a floating loan. This is a fixed loan, so it certainly wasn't expiring. This particular seller is extremely rich and has a large number of properties. And basically, each property has a life cycle, if you want to call it that. And he's divesting some portion of his portfolio. I think that, investors who have 1 property, they think one way. Investors that have 20 properties think a different way. They're always buying and they're always selling.
How do you estimate absorption rate?
We don't estimate absorption rates. We don't have the capability of doing that. Absorption rate is usually estimated by companies who take their data from, source companies like CoStar or Yardi Matrix. So CoStar has 50 Prius cars that are driving around the United States, and every time they see a construction site, they go in there and figure out when that site will deliver. Then they total up all of those, and that is your incoming supply, right? Then they calculate how many units the market is absorbing based on its growth rates, how many households are being created, what are the income levels and the inward migration. So they calculate all of those and they come up with an absorption number. And then they share those numbers with in their forecasts, and that's what we're using. We do not calculate absorption numbers.
Can you speak to a fixed 5-year IO loan given anticipated rate drops? Are you precluded from refinancing? Either way, the fixed and known loan payments with 79% LTV helps underwriting and thus cash flow projections, correct?
It is. So one of the nice things is the fact that this loan is fixed for the next 5 years makes it much easier for us to project cash flow, right? If it wasn't fixed, it was floating, then obviously that job is a lot harder. Now, today, let's say that it didn't have an assumable loan and we were going out in the market and trying to get a loan, we'd be around 6.3%, maybe 6.2, something like that, right? So we would already be 100 basis points higher than the property. Now, let's say that the Federal Reserve drops interest rates by 100 basis points. So 1 year from today, 1 year into our ownership, the rate would be where we are. So obviously it would make no sense to refinance then. Well, then the rate might continue going down, probably will. And let's say it ends up at 4.3% in 2 years. And that's probably where it'll stop. Now, that 100 basis point difference is probably not enough to refinance because we'd have to pay a penalty to refinance. But let's say it, for whatever reason, something like COVID occurs and it drops to 3.3%. Then we can basically say, does it make sense for us? The rates drop by 200 basis points. Should we go in and refinance and basically just pay a penalty? So it's nuanced. Are there high chances that we'll refinance during the next 5 years? No, they're low. Are they zero? Certainly not. It really depends on how much the rate drops and when.
Sorry, Neal. The chances that we refinance are low to nil because we have a fixed 5-year loan with yield maintenance with Fannie Mae.
Right, right.
But
the example I was offering.
In your example, you were talking about a fictional example if we had a variable rate loan, right?
Well, no, I think no. What I was saying is, with any loan, you can refinance it, but you pay a penalty, and that penalty is pretty large. Now, each year, as the time goes on, that penalty decreases. So for the next 2 years, the chances that we refinance are nil. After that, if rates drop to 3%, it may make sense to pay that penalty, right? But what's likely to happen is if there is a refinance and the property is doing really well, we probably might refinance 3 years from now. Because in the first 2, maybe even 3 years, the loan defeasance penalty that we have to pay when we refinance is too high. It wouldn't make sense.
Okay, so this person has a series of questions, which I will answer, give them an answer at the end. This person says, I believe your business case for Chattanooga and the assets. Can we talk about the deal specifics and deal economics? What is the year-over-year rent growth assumptions you're building into the property? What other value add assumptions? What is the fee structure? What are the property management expenses and asset management expenses layered onto the revenues? Well, my friend, all of those questions and more are answered if you watch the 40-minute video walkthrough with Pete Levine and myself. It's available on the link that we put into the chat, at growcapitalist.com/MTRKit. You can put it on your video immediately after you leave here, wake up to it in the morning. It's a very, very thorough walkthrough of the Excel spreadsheet and a talking through of all of those questions that you just asked. So we welcome you all to watch that. And if you have any questions, please meet with Peter Majeski and he can take it from there.
Yeah, and we love it when people ask that question. We love it when you go through that 40-minute video. But we know that there's a lot of investors that don't want to do that. They simply want to listen to the basics. But yeah, for those of you that want to dive deep, please go in there. You'll find that the assumptions are quite reasonable.
Yes. How are the other 2 investments in the fund coming along? Are they meeting, beating, or lagging the pro forma?
Anna, your thoughts?
Well, I would say that one of the assets had a little bit of a slow start. That's Park Avenue Villas. And our other asset, Monarch Villas, has 99% occupancy and had a challenge with the city that it is now in the process of overcoming. So I think 2024 is going to be a very good year for both assets, although they both had a little bit of a bump So I think, definitely we're looking at distributions in 2024, and things are looking very bright. I think all three assets are excellent acquisitions, but sometimes it can take 6 to 9 months for a project to really get off its feet, especially when you have unknowns like the city of Sandy Springs coming down on all multifamily in the area.
All multifamilies in the area. So that increased our expenses there, but that property has outperformed our occupancy, both economic occupancy and physical occupancy since every single month of ownership.
Yes, and the story that we're telling you, you're welcome to look at every project that we have. There is, including Grow Fund, you get a monthly investor update. So the full story, you can look at the investor update and go back and read every investor update and watch every webinar to get all of the details of what's been going on. So definitely something you may want to do so that you have all of the details. Let's see. Does the return include all the fees?
All of the fees are included in the returns. These are returns net of any fees. They're also net of our profit splits. So our profit and our fees are removed.
Can it be IRA or 401k funds?
Yes, actually we didn't say that, but it's eligible for self-directed IRA funds, also eligible for solo 401k funds. Actually, that's on the screen. Yay.
Yeah. Is the cash on cash being distributed monthly? No, Hugo, we distribute quarterly.
Yes, we're a small team and monthly distributions just impact the team's performance too much. So we do quarterly distributions.
Here's a great question. Is the tax treatment any different if you're investing in a fund versus directly into the property?
Well, not necessarily. You're essentially let's talk about depreciation. You're getting depreciation from 3 properties and it's being spread out across. The fundamentals of tax avoidance do not change whether you're buying 1 property or 3.
I'm trying to understand why the value decreased so much from the August appraisal.
Honest answer is this, that at this point, the interest rates are high. So right there, 6.3%. So when people are looking to buy the property, they're going to set the value based on the interest that they have to pay. Now, we're not paying that. We're at 5.3%. So obviously there's a big gap there. So the bank looked at that and said, yeah, it's a 5.3% loan. We know how much interest is being paid and we're going to assess it accordingly, which is fair. But today, the vast majority of buyers, they don't have access to assumable loans. A lot of loans are not assumable, or maybe they're getting over in the next year, so it doesn't make sense to assume them. And so those buyers are looking at the market and saying, hey, I probably have to pay 6.3, 6.4% interest. And until the Fed starts cutting, which is 4 or 5 months from now, these rates could still go up. And so they're doing their underwriting on that basis, and they're willing to pay on that basis. And so that's why the huge difference.
Let's see. Many projects are withholding cash flow in the current market. Will this project have a quarterly payout?
Well, we feel comfortable, we feel confident about that for 2 reasons. Most of the projects that are withholding cash flow, they've suspended cash flow. We've seen that happen. I would tell you probably 90% of those were floating rate loans. And when those rates floated up and up and up and up, either basically a lot of the cash flow went towards paying the mortgage or went towards paying for expensive rate caps, $1 million, $1.5 million rate caps. We have a fixed loan for the next 5 years. There is no rate cap. So while I would say that the biggest single reason that the vast majority of properties that have stopped payments, including ours, by the way, some of our properties have also stopped distributions for these reasons, is variable loans.
Let's see. I'm not quite sure where this one comes from. Why was the pro forma occupancy for Chattanooga down in first quarter 2026? Orange line. I think you have to go back to.
Sure. I will take a look. So we'll go back to that particular slide, but keep going with the questions while I find the slide.
For fund investors, is their investment split into 3 equal parts for each property?
No, because some properties are more expensive than the others. For example, this property is double the price of Park Avenue Villas, so it would have double the impact. So
Yeah.
I would say
So more of your
probably a
money
40%
in this
impact would be in
property.
this
Yeah.
property. Yeah.
Yeah. The exit cap rate is a question. There actually is, so the exit cap rate is 5.25%. It is in the underwriting video.
Yes. So it's and reasons for picking that are we've discussed all of these reasons amongst ourselves. We feel like that number makes sense.
Would this property require the full value add to perform as anticipated, or as part of its success simple appreciation? No, we don't rely on simple appreciation. The property would require the value add that we have identified, which again is taking 79 classic units to a partially renovated state. Thus, for a 1986 property, you would have effectively 100 partially renovated units. And I have to say, the renovations by the current owner, they're not so good looking. I couldn't tell the difference between the classic units and the partially renovated units myself. So there is a lot of meat left on the bone. Our 79 will look better than their 79 partially renovated, but none of the units will have been taken to a full renovation, which is, considered to be granite, stainless steel, et cetera. So there is a lot of opportunity for the next owner to come in, and our business plan is only 79 classic units taken to partial renovation.
And I'm ready to answer that question. The reason why there is a sharp decline in projected occupancy, the blue line, in Q1 2026 is it's very likely that there is a major project, let's call it 400 units, that is projected to deliver right about here. So when that 400 units delivers, it tends to drag down the rents in that marketplace at that point of time. And when it drags down the rent, occupancy drops because all of a sudden those tenants are getting redistributed because all these 400 units are getting delivered. So as those units get delivered, if the market absorbs them, and this market is absorbing them over these 3 quarters, this one, and this one, then occupancy over time returns back up.
Let's see. So we have a couple of people asking, when will the quarterly distribution start? So it's actually in the FAQs, Neal. Basically, the quarterly distributions, it always takes us at least a quarter to stabilize the property because there's a lot of ups and downs, bills coming in from utilities and all kinds of stuff that's a little crazy the first 3 months in terms of billing. So we need it to even out. And so we're anticipating distributing the after the first full quarter of ownership. And then the secondary, sorry, Neal, I don't know exactly what.
Well, I don't know where it is because there's so many FAQs.
Yeah, I know there's so many FAQs in here. Anyway, that is the, so it's after the first full quarter of ownership. And then when do we anticipate the fund will start distributing? I would anticipate the same timeline at this point that we would start distributing in the same timeline. Have you visited the property? Why, yes, we have.
Yes.
You saw the video. That was our director of acquisitions and development on site, Pete Levine. In fact, tomorrow our director of asset management will be on site, meeting with our property management for 2 days. So this is our due diligence period, and we are on site and doing a lot of work there right now. Let's see, when was the property built? It was built in 1986. Has the growth fund stopped any cash flow distributions on the other 2 investments? So, well, it did not stop.
Yeah, right. Yeah, we haven't started yet, but the key thing is you should know that a fund doesn't distribute, by property. There would be one distribution to you when you're investing in the fund, and that would be from profits gathered over the 3 assets. So you might have one asset that's underperforming and one that's overperforming. That sort of makes up, and that's why people like the idea of investing through a fund rather than investing into an individual property. But we haven't started yet.
Let's see. So this property will be co-owned by both the fund and direct investors. how much of the fund's money goes into this property, or what will the fund's ownership be of this property?
Well, that depends on how many of you choose to invest through the fund versus how many of you choose to invest individually. In the end, it really doesn't matter. Think of the fund as one big investor, right? So instead of
Right.
investing 125,000, that big investor is putting $2 million or $3 million into the property, and the rest of the investors are investing $100,000. That's the way to look at it.
Yeah. Are the returns lower if I invest as a 1031 into this property?
No
No.
difference at all.
No
Yeah.
difference. I'm not sure what this means. Can you guys take the foundation money?
Don't know what that means.
Okay. I currently invested 75K into the growth fund. Can I add another 25K to my investment now? The answer
Sure.
is yes. Sure,
Yeah.
sure. We'd be happy to do that. And when we put out our last property, Park Avenue Villas, we had a lot of investors do that as well. Let's see. I've already invested in the fund during the first 2 investments. Can I invest directly in the third property independent of the fund? Sure.
Of course. Yeah.
Yeah.
No issues.
Yeah. Now, we did have another question related to this that was said, when you launched the fund, you said it would be the only way to invest in value-add projects. What changed?
What changed is that we have investors that still like investing into individual properties. I believe that investing into the fund is the best way. I told you that then. I'm telling you that now. But many investors want to invest individually, and it's not for us to decide how people should invest.
I would just add on to that this property, because of the timing of a property we just exited, and we are taking a 1031 group with us, and this was by far the best asset that we could present to them. So we have a group that are 1031ing into it. A 1031 can't go into a fund. They have to go directly into a property. So we had to allow, in this case, direct investment into this asset. And so once we had to enable that, we opened it so that people could do that directly as well. Let's see. Who gets liquidation preference? How many share classes are there? What are the specifics? Maybe you could go back to the class structure.
Right. So let's say we're selling one of the 3 properties in the fund. Nobody gets any preference. It's being divided. So let's say, right? So let's say on the B1 side, these guys have 5 million. On the Class C side, these guys have 1 million. Well, these guys would get, let's say there's, $60 of returns. These guys would get 50. These guys would get 10. So it's a share of, what the investment that they've made. So they're all next to each other. Nobody's ahead of anyone else.
Why would you get a fixed rate loan in an environment of declining rates?
For one simple reason, if we wait until rates go down, so let's say we wait for 1 year. Well, the projections are, rates will decline by 100 basis points. So if today they're at 6.3, then in 1 year they'll be at 5.3, right? So now we miss out on that 1 year. But when rates go down from 6.3 to 5.3, don't you think the values might go up? Because the only reason that multifamily prices have declined, demand is extremely high. The reason they've declined is because rates are high. So a year from now, we're still at 5.3, but we may not get this price. Now, 2 years from now, they may be at 4.3. Well, now the prices might be much higher. Wouldn't you want to buy today at today's depressed prices so that 2 years from now, you basically banked millions of dollars as prices go up, as rates go down? Rates have gone down, rates have gone up, prices have gone down. Rates will go down, prices will go up. So it makes sense to buy now, right? Not a year or 2 years from now. I'm not saying it may be a bad time to buy 2 years from now, but today is actually a terrific window.
Let's see. What happens to the invested money prior to deployment?
We do not provide returns prior to deployment. Basically, we're collecting money and we're waiting to close on the property. Remember, the bank needs to see, about $8 million in our bank before we can close. So that's part of the investment process, but your clock starts to tick when you've invested into the property when the property is purchased. If you invest in the fund, then your clock starts ticking immediately.
Was there ever a capital call by Growth Capital?
Yes, we've had 31 projects. We've had one small capital call, and that capital call was $1.5 million. Investors had invested $5 million. We put in 40% of the money for the call. So far, the investors have put in about $500,000. So that was for an asset that's a new construction asset. So we've never done a capital call or even really contemplated a capital call for a value-added existing asset. So for that particular asset, as you can imagine, construction loans went all the way up to 11% as rates floated up. And so we needed extra money to finish the property.
Let's see, when do you anticipate selling each of the 3 properties in the fund?
Well, at roughly the 5-year point. So, for the first property, we bought it 13 months ago. So about 4 years from now. For the second property, about 4.5 years from now. For this property, about 5 years from now. So your money might be in the fund a little less than 5 years, because if you average it out, that's about 4.5 years.
Why do sellers seem to be selling only partially renovated rather than completing? Or why would a Growth Capital only have a few premium units to demonstrate to next buyer to increase IRR?
Well, for the same reason that we believe we can sell to someone else 5 years from now. You leave some meat on the bone. This seller is leaving meat on the bone for us, right? Because it takes time to absorb these units as the market goes up. You don't want to renovate too many units at once, and we never do that. We'll renovate 4, 5, 6, 7 units a month. We don't renovate more than that, because now you're increasing rents and it takes time to absorb that. So this is a process. It takes time. They've gotten to the point where their investment thesis is met. They probably double their money, so they're leaving, and we are going to then start to renovate again to a higher spec granite countertops when we are leaving that meat in the bone for the next person.
Yeah, I mean, if you renovate everything and there's nothing left to renovate, your property is worth less to the next person. Your cap rate will be increased. Not a value add. It's a stabilized asset. If I invest into the fund, will the returns from me be the same as people who invested previously in terms of cash flow and returns at exit?
Say that again.
If I invest into the fund now, will the returns I get be the same as investors who invested previously into the fund?
You do. So this particular fund does not have what is known as a true up. So the people that invested a year ago at the beginning of the fund and the people that are investing today get the same return. Yes.
Is diversification the main and only reason you personally prefer the fund investment route?
Yes, I also prefer it because the clock starts ticking the day that you give us money. Whereas with a individual property, your clock's going to start ticking when we finish the purchase. So you gain about 2 or 3 months there.
I think this question was asked before. When do you estimate you will close on the property? In other words, when can we expect the clock to start ticking for us? March or April? Is there a double layer of fees when investing into the fund? Specifically, are there fees at the fund level?
No, that would be problematic.
There actually is a fee. There is an admin fee at the fund level, but no other fees. There's no acquisition or asset or anything. All of those are at the underlying level.
Yes, I want to point out that fee is extraordinarily small compared to our other fees. So if you compare the big fees that we charge, and you're looking at this admin fee, it's a very small amount.
This person, I don't know, has already jumped into something. It says in the pro forma, the year 1 NOI is 1.795 mil and a purchase price of 29.6, giving me 6.1 cap. How do I get 6.8 cap? Well, Greg, that has to do likely with the adjusted property taxes and insurance. So we're talking the 6.8 is an adjusted cap rate.
Yes, and by the way, that is in the underwriting, so you'll be able to see those
No, I
adjustments
think
in
they've
that
already
video
jumped it. They're
underwriting,
already in the video, Neil.
right?
They've already jumped into the
They're
video
ahead of us.
interview.
It's like, wait a minute, wait a minute. I'm still looking at the video.
Okay, Neil, I think we are at time.
Yeah, well, thank you everyone for attending. Fantastic questions, amazing list of questions. And based on the poll, I think that we're going to do very well. So end March now looks more likely than April. So thank you everyone for your time, and we will see you on the next one. Bye-bye.
Bye-bye.